The title of lesson 3 is resistance and support. In our previous lesson we learned about candlestick formation, how candlestick is used to interpret price movement, how we can spot change in price movement. And this lesson 3 we'll be talking more about resistance and support, how resistance and support are identified and located, then price behavior at resistance and support level. Now let's look at this chart. We are having an illustration. Okay, we are having a ceiling and a floor. If a ball is bounced at the floor, and if the rate at which it was bounced, it has a very strong push. The ball will move up to the ceiling, and if the ceiling is very strong enough, it will bounce the ball back to the floor. This also can be likened to resistance, support, and price. Once market price, that is the ball, rally increases and reach ceiling, that's the resistance, it is rejected, starts moving down to the floor. So in FX we are seeing basically how price is moving between support and resistance. If the resistance is very strong, price will be rejected at the resistance level and start moving to the next support level. And if the support level is strong, it will reject price and the price will move to the next resistance level. If price is strong enough to break the resistance level, it will be broken and it will move up. Now let's look at what resistance is. In a rising market, the level at which market is rejected before depreciating is known as resistance. Okay, so in other words, resistance is a price level that bounce price back to support level. So in a rising market, once price gets to a price level at which the up move is rejected and price changes direction and starts moving down, that level is known as resistance. And look at the chart we have here. We can see resistance as price is moving up, creating resistance, coming down, creating resistance as it moves further up. Support. In a falling market or when price is dipping, the price level at which price was rejected before moving up is known as support. Now when price is coming down from a higher point, it will get to a point, a level at which the dip will lose its momentum, and the support level, a price level at the support, will reject that movement and changes direction to the up move. That level at which price changes direction is known as support. So resistance and support are just level of rejection. If price is rejected at the top, the price level at which price is rejected is known as resistance, and the level at which is rejected at the bottom is known as support. And we can look at the chart. We have support as price is going down, being rejected, moving up and going down, is creating support that is going down. Theories of resistance and support. We want to discuss more about the theories of resistance and support. This will really help us to understand price behavior, price action at resistance and support level. It will help us to understand what will most likely happen at resistance and support level, And if we can know this beforehand, it will help us to take a good decision whether to trade at that level or to ignore it. Theorem 1. Resistance stroke support are either broken or it hold. Resistance stroke support level is either broken or it holds. Now, here is a chart to illustrate that. We have a resistance level as defined, stated on the chart, a resistance level, and we could see price moving up, trying to break it, and finally it was broken. So price broke to resistance level. So what will happen is, at resistance level, is either the resistance or the support level is holding, preventing price from moving up at resistance level, or preventing price from coming down at support level, or it is broken. And then we can see how price broke through the resistance level. Here is a short illustration of price breaking resistance level. Still theorem 1. At this point we are looking at price action, price behavior at support level. Okay, so here we'll see the support level. Price starts moving down, and once it got to that support level, we can see that arrow, price was rejected and starts moving up. So here is to show us the chart claiming that once price gets to support level, it's either they are holding or is broken. And we can see at this point that support is holding firmly. This supports our claim for theorem 1. Theorem 2. When support to resistance is broken, it is retested and continue moving in the new direction. Let's look at this chart again. We have support broken. At that support we have an evening star. The support is broken to the downside, and once it was broken, it came back again to retest that broken support level, and price started to move down, and we'll see a bearish continuation movement in price. So what this one is telling us is, if a support is broken, most likely price will come to retest that broken support and continue moving in the down direction, in the bearish direction. Still theorem 2. This is relevant to resistance level. Now at this point of resistance level, we saw how price was broken. Price broke the resistance level upward, and it came back again to retest that resistance level before moving north. So once a resistance level is broken, it is expected the price will come and retest that level before moving up to the next resistance level. Trend and trend types. In this section we'll be talking more about trend, the type of trends we have, and what is a trend. Now, what is the definition of a trend? Trend is a price movement over a period of time. Trend is a price movement in a direction over a period of time. In any financial market, there are two major players: the buyers, which stands for demand, and the sellers, which stands for supply. These theorems have been in place right from the time of Adam Smith. Buyers and supplies are the rulers of the market. Any open and closed market is being governed, ruled by the buyers and sellers. Without buyers and sellers, there won't be any trend, and there won't be any markets. So the buyers and the sellers dictate the pace in the market. The relationship between the two players give what is known as a trend. There are three types of trends, namely bullish trend, bearish trend, and consolidation. Many have argued that consolidation is not a trend, but I'm here to tell you that once price is moving between support and resistance, as long as we can know that price has hit a support level and is expected to hit a resistance level, that is a trend, because we can now speculate where price is going based on previous price action. So consolidation is a trend, but trend moving in a channel. Bullish trend. Bullish trend is also known as a rally. It emerges when there are more traders willing to buy than sell. When we have more buyers in the market, we have a bullish trend. When we have more buyers, when the buyers are more than the sellers in the market, we have a bullish trend. And a bullish trend is when price is rallying, when price is increasing, when price is appreciating. That's a bullish trend. In a bullish trend, price is waving, that is moving, creating a higher high and a higher low, thereby leading to price appreciation. In a coming lesson, we are going to talk more about this higher high and higher low. But for now, let us get this understood that in a bullish market, price is making higher high and higher low. The previous higher low must be lower than the next higher low. So that way we are moving up and creating higher low and higher high consistently. Bearish trend. A bearish trend is also known as a dip. It emerges when we have more traders willing to sell than buy. When sellers is greater than buyers, we have a bearish trend. In a bearish trend, price is waving, creating lower high and lower low, thereby leading to price depreciation. We can see from the chart how price is making a low, lower high, lower low, lower high. The previous lower high must be higher than the next one. That makes the trends to be valid. Consolidation. When price is moving between equal supports and resistance, we have a consolidation. And consolidation is a sign that there is no interest in the market. Consolidation is when buyers in the market are equal to the same number of sellers, when demand equals to supply.